Hello and welcome to the first edition of Capital Market for the year 2022, live on Channels Television. I'm Will Ibang here in Lagos. First things first, let's check in on the markets. We start with Europe, where stocks indexes fell on Friday, the last trading session of 2021, but logged gains of over 22% for the year. The UK's FTSE 100 fell 0.2% on Friday, and France's CAC 40 slipped about 0.3%. Markets closed at lunchtime owing to the New Year's Eve celebrations, while the German DAX was short all day. And then the FTSE and the DAX saw gains of around 15% for the year, while the French CAC logged a rise of nearly 30%. Now to Asia, where Hong Kong stocks led gains among major markets on Friday, with Chinese tech stocks in the city soaring. Markets in Hong Kong closed early on Friday for the final trading day of the year. Elsewhere in Asia, markets in Japan was closed on Friday. The Hang Seng Index in Hong Kong jumped 1.24%, paring some losses but still tumbling about 14% for the year. Mainland Chinese stocks closed higher, with the Shanghai Composite up 0.57%. Now to U.S. markets, where stocks finished the final trading session of the year lower, capping off a record-setting 2021 that came despite the persistent headwinds of COVID-19. The Dow Jones Industrial Average on Friday fell 0.16%. The S&P 500 pulled back 0.26%, while the Nasdaq Composite dipped 0.61%. All three indexes finished the month higher. December marked the Dow's fifth straight monthly gain, and the Nasdaq recorded a 6-month winning streak. The major averages posted double-digit returns for this year. The S&P 500 rose 26.89% in 2021, marking the benchmark's third straight positive year. The Dow and Nasdaq also notched 3-year winning streaks, gaining 18.73% and 21.39% for the year, respectively. Now, back home to the local equities market. The local equities market ended the last trading week of 2021 on a bullish note as the all-share index edged up by 1.07% to close at 42,716.44 points, driven by investors buying interest in Nestle, MTN Nigeria, Access Bank, and Zenith Bank. Accordingly, the month-to-date loss moderated to 1.2%, while the year-to-date gain for the index closed the year at 6.07%. That's substantially lower than the 50.03% gain recorded in 2022. Activity levels were stronger than in the prior week, as trading volume and value both increased by 3.1% and 6.1% week on week. Performance across sectors was broadly positive as the consumer goods, banking, and insurance indexes posted gains, while the industrial and oil and gas indexes declined. NEM Insurance topped the gainers chart for the week, while May and Baker led the laggards. Now, the three of Jay's Bank, of FBN Holdings, and Zenith Bank contributed 348.89 million shares worth 3.42 billion naira to the total turnover in the week. Now to the unlisted equities market, where the NASD OTC Securities Exchange Index closed the week on a positive note as well. The NSI return increased by 1.09% to close the week at 742.85 points against 734.82 reported on Friday, December 24, 2021. Also, the NASD OTC Securities Exchange market closed the year on a positive note as the market recorded an increase in performance. The NASD Security Index year-to-date returns increased by 1.34%. Over to the fixed income market, where the bond market was mostly quiet this week, with minimal volumes traded across the board. At the close of trading on Thursday, the market closed mixed with sell pressure majorly at the short end of the curve. Overall, average benchmark yields closed at 8.089%, indicating an unchanged week-on-week overall performance. The Treasury bills market was unchanged for most trading sessions this week. At the close of trading on Thursday, the market was mixed with selling interest in across OMO bills and CBN special bills. Across the benchmark, yields for Treasury bills fell by 0.56%. Yields on OMO bills rose by 1.1%, while CBN special bills dipped by 3.16%. Now, joining me on the program from our Abuja studio to assess the capital market for 2021 is Uche Uwaleke, Professor of Capital Markets, Nasarawa State University, and the President of the Association of Capital Market Academics of Nigeria. Welcome and thank you for coming on the program, Prof. Hello, Prof.
Yeah, thank you very much, Will. Let me say Happy New Year to you, and also Happy New Year to Nigerians. And this is wishing all Nigerians out there a prosperous New Year. I'm actually delighted to be your first guest, on your program this year in 2022.
Thank you so much, Prof. Now, we're just going to state that the year 2021 has ended, has indeed been a momentous one for the Nigerian stock market, but many stocks far outperformed the Nigerian exchange's benchmark performance indicator, and that's aided the market to gain about ₦1 trillion at the close of business, as in the year. But first, let's take a quick listen to the NGX year-end digital closing gong for 2021. Prof, 2021 ended with year-to-date return in the equities market at 6.07%. This is far below the result for the previous year, 2020, when the stock market emerged the best globally with a return of over 50%. Now, what possible factors could explain this wide disparity in performance, seeing that we had COVID in 2019 and 2020 was possibly a lockdown year? What really caused, what are the factors that are driving this disparity we see now?
The market, as you know, is one market that obeys the laws of gravity in the sense that, what goes up, must come down. And for stock markets, generally, you don't find them, going up and staying there, or even going down and staying there. So you find the markets, doing up and down. But I agree with you, the disparity is quite wide. Remember, too, that in 2020, the market actually began to respond, began to gain traction towards the last quarter of 2020. That's talking about October, November, and December, up till September of 2020. And August, the market was in the negative territory. That's the equities segment. So it was the last 3 months of 2020 that we saw those traction. And that was primarily because in the month of September, if you recall, the central bank dropped the MPR by 100 basis points to the current rate that it is today. That's 11.5%. So the fact that interest rates crashed, if you like, we had liquidity in the system. The central bank was implementing a lot of measures that injected liquidity in the system, the loan-to-deposit ratio, for example, and all manner of interventions, including interventions by the federal government, to stem the ravaging impact of COVID. So that's injected liquidity. Interest rates, crashed in the fixed income space, and of course, naturally, attention now, became diverted to the equity segment. So that was why we saw that jump. Now, coming to 2021, as I said earlier on, it became natural that in the course of the rise we saw in 2020, some equities must have been mispriced, and then market correction, began taking place. That's one. The second thing to note in 2021 has to do with the fact that, again, interest rates began to rise. We are beginning to see increase in yields in the fixed income space. You just mentioned its average yield now is about 8%, for most maturities. So you find that as yields go up in the fixed income space, of course, investors will shift attention to fixed income. That's natural. Again, taking into cognizance the fact that you have an inflation rate that is still high, still double digit. So any investor is looking at real rate of return, and the type of returns that we're getting from the stock market, does not cover. If you adjust for inflation, doesn't leave you with a positive real interest rate or real return.
So, Prof, what you're trying to
6.07%.
What you're trying to say is that there's high volatility.
We saw
there's high
in
2021. What you're trying to say, Prof, is that there's high volatility in returns in the market. So what do we do? How do we curb this? How do we curtail this?
With high volatility. Well, is to ensure that we have a stable, macroeconomic environment. Again, we don't have a policy somersaults. And also, one of the things too that has happened in 2021, which I think when it crystallizes and begins to function properly, it will also help to reduce volatility. And that's talking about the introduction of a derivative products, in our markets, today. The Securities and Exchange Commission has licensed some derivative contracts, and once they begin to trade, of course, investors will be using them to hedge risk. That will have a way of reducing the volatility. But what's important is that the performance of the market is not divorced from the entire happenings in the macroeconomy. So we need a stable macroeconomy. We need certainty in the investment space for us to have for us not to have this kind of volatility.
Well, okay, we're talking about certainty in the space. But the bond market, for example, is a space where investors gain some level of certainty in terms of returns and, risk, lower level of risk. So what is your general assessment of the bond market, the fixed income market in 2021? How do you think it has performed? Yeah. Would you say that they did better than they did in 2020 against 2021?
Yes, of course. There appears to be a trade-off between performance in the equity segment and in the bonds market. One can say that the bonds market in 2021 performed, relatively better. We can still talk about strong investors' appetite for bonds, for fixed income, for obvious reasons. Of course, they appear safer. Some see them as a safer asset class. So that's why you have investors showing interest there. And if you even look at the investors that are playing in that space, you have institutional investors, pension funds, for example, who want to invest in asset classes that are considered safe. And that's why you find that the bonds market doing well. And remember too that the bond segment of the capital market is dominated by government securities, and these are considered risk-free to a large extent, which is why, if you recall, not too long ago, the FGN Sukuk bond was out there. There was an issue of 250 billion Sukuk not too long ago, which was oversubscribed by as much as by over 800 billion. So that tells you that the investors' appetite for bond is quite high. And again, given the return that it usually promises, that bond was issued at 12.8%. You don't have that kind of return from the equities market, and so naturally you find investors, if you like, rebalancing, or fund managers rebalancing their portfolio in favor of the bonds securities.
So would you say that, since you say that the bonds market is a safer market for investors, especially for people who want higher returns, and you talk about the Sukuk bond, which was oversubscribed, we also had the Euro bonds for 2021, which was also oversubscribed. These are the things that we see that investors are actually eyeing. But for the Euro bonds, we had some foreign investors, but equities market, we've seen like an exodus of foreign portfolio investors. Domestic investors dominate actually transactions on the Nigerian exchange now. What do you think should be done to attract more foreign investors? Because we see that foreign investors pulled out a total of 173.32 billion naira from the Nigerian stock market from January to October last year. How do we stop that? How do we attract foreign investors into our stock markets?
Yes, that has been the trend, Will, since 2020, January 2020. Of course, not helped by the COVID, by the pandemic. The pandemic saw a lot of foreign investors, leaving the scene, such that as we speak, domestic investors, dominate transactions in our markets, especially the equity segment of the market. If you look at the NGX domestic and foreign portfolio reports, of course, the NGX pulls this data from market operators on a monthly basis with respect to their domestic and foreign portfolio investment flows. The latest that we have there, I think, is that of November. And it talks about domestic investors, dominating transactions in our market. And if you look at the trend, that has been the case since January 2020. Although we saw some improvement between October and November of 2021 in terms of foreign investors participation. But by and large, foreign investors, of course, would come if your environment is right. If at the macro level, for example, you don't have issues around insecurity, forex challenges, and so on.
Of course.
So the environment has to be right for foreign investors to come. But again, remember too that when we talk about returns, yes, Nigeria as a frontier economy will usually offer a higher return. But if you look at it on a risk-adjusted basis, you will find that returns even from developed countries, especially now, appear better. And we are also going to, we may see some of these capital flow reversals, more of that, with the impending, interest rate normalization from developed economies, especially the U.S.
Interesting thought there, but we'll just take a short break now, and when we come back, we'll continue the conversation, and that's in a moment. Do stay with us. This is Capital Markets. Welcome back. If you're just joining us, this is Capital Market Live on Channels Television. 2021 was a year of demutualization of the stock exchange, and also in 2021, the NGX listed by introduction on the main board of the exchange. Now, Prof, the performance of the market so far, does it seem to suggest the benefits of demutualization, that demutualization has begun to manifest? It doesn't seem to look like it. It doesn't seem to look like demutualization has kicked in the stock exchange or the NGX. What's your take on this?
Yes, I think the benefits of demutualization or the positive impact it is going to have on our markets may not be visible now. It's going to take quite a while because we expect that following demutualization, a lot of issuers will be attracted, to the market. So that is something that is, I think, will still happen, but it's still early to judge, to say, because we have not seen, sufficient traction. Then the demutualization is not having any impact. I think the impact, will be felt, with time. And it's also good that the NGX completed the entire process by also listing, listing on the exchange. And of course, as you know, having a separate regulatory arm. I think all of that will rub off positively on the market, in due course.
Talking of the regulatory arm, on a scale of 1 to 10, how would you rate the effectiveness of the capital market regulation in 2021?
Okay, on a scale of 1 to 10, how would I rate capital market regulation? Let me be sure I understood your question. I think overall I would say above average in the sense that both on the part of the apex regulator and also on the part of the self-regulatory organizations. I think I would give them an above average score because that is also what has also helped to restore confidence in the markets. I can say that confidence in the market is gradually building up. I'm aware that in the course of the year, for example, the Securities and Exchange Commission had to move against a number of Ponzi schemes. And the apex regulator also came up with a number of rules and and regulations to further firm up the market. And remember too that it was the enabling regulatory environment, fostered by the SEC that made it possible for the exchange to complete its demutualization, process. So I think regulation has been, quite on the right track, and going forward is something too that will continue to be positive for the market.
Oh, now your above average score is getting me, piked, my interest piked to know what your outlook could be for the new year with respect to the economy and the capital market. Especially now we see that the FMDQ exchange is set to acquire 21.6% equity stake in the Central Securities Clearing System. What do you expect for 2022, Prof?
Yes, I'll start by saying that the news came to me as a welcome development. FMDQ acquiring significant interest in the CSCS. Of course, FMDQ is one of the leading market infrastructure in Nigeria, and indeed in Africa, if you look at it from the point of view of the move by the FMDQ, to completely transform to a full-fledged, securities exchange. So from an OTC platform to a full-fledged security exchange, that is a major move, a strategic move, by the FMDQ. So it will strengthen the post-trade infrastructure. It already has two wholly owned subsidiaries, talking about post-trade infrastructure, the FMDQ Clear and the FMDQ Depository. So with this one, of course, that will further put it in a good state to perform all of its functions. And of course, for CSCS, it's also going to help to further strengthen it. As we speak, I think the share price is around 17 naira. Of course, it's listed on the NASDAQ. I think with this move, I see further appreciation in the shares of CSCS. So going into 2022, I want to be optimistic that the markets will pick up. But the reality is that a number of factors will shape performance of this market in 2022. Some of these I've mentioned about articulated in an article I just finished doing on. I titled it "Crystal-Gazing the Nigerian Stock Market in 2022." So I identified a number of factors that will shape performance of the market in 2022. Yes. Okay. Some of these factors include the endogenous ones, I call them. Locally here, the central bank monetary policy will continue to remain key. I see the central bank changing monetary policy stance in 2022. So far you can say they've been adopting an accommodative monetary policy stance, but that may not last. Central bank is likely to tighten monetary policy in 2022, and that is going to be because of the fact that the central bank will try to, rein in inflation because of the threats to inflation that we'll see in 2022. The implementation of the Petroleum Industry Act will, of course, result in a higher inflation rate in the near term, especially when fuel subsidy is removed. The exchange rate issues will also be there. Remember, 2022 is a penultimate election year, and if history is any guide, especially recent history, you realize that in 2014 the market was down by over 16%. In 2018, another penultimate election year, the market also was down by over 20%. And in 2022, I won't be surprised again if the market, is down as a result of political uncertainty associated with, penultimate election years. So it's important that.
There's something I just want to say because I wouldn't want us to leave without having said it. The president still looking ahead. The president just signed the 2022 budget into law, and he had certain concerns. And one of it was the reduction in the provision for the sinking fund to retire maturing bonds. How do you think this is going to impact the capital markets or impact the fixed income market? What are the implications of this?
It also came to me as a concern that the sinking fund provision, was being reduced. As a matter of fact, if anything, we should be increasing. We should be increasing it because it's very critical. It's very important that the government doesn't default on its, debt obligations. These are usually funds set aside to retire maturing obligations, especially bonds issued to local contractors. So it's important that that sinking fund is not reduced, because if it is reduced, for example, and the government defaults, it of course it doesn't speak well for the credibility of the government in terms of meeting its obligations, which is why I think it's a very good strategy to create a sinking fund to retire maturing obligations, so that you retire your debts effortlessly. Okay. But when you now reduce it and then you find it difficult meeting your obligations, it doesn't, as I said, augur well for government.
Prof.
Remember, government
Prof.
securities, government bonds are said to be risk-free. Risk-free in the sense
Prof,
that government is always expected to
there, Prof.
honor
We have
its
to leave it here,
obligations.
Prof. Prof, we have to
Default
leave
risk
it
is
here,
virtually
Prof.
zero.
Prof, we have to leave it here. Many thanks, Prof. Uche Uwaleke is a professor of capital markets, Nasarawa State University, and president of the Association of Capital Market Academics. Thank you for joining us. And that's a wrap on the program. Don't forget to join us same time next week. I'm Will Ibong. Thanks for watching. Stay safe and Happy New Year.